Misconception number 5 is my firm doesn't charge fees. It's not actually that simple, because when you look on television, you often see these commercials enticing self-directed investors with the allure of low or no trading costs. In reality, there are actually 3 different types of costs associated with having a financial advisor or within the broader context of financial services. The first is the investment cost. The second are the administrative costs. And the third is the advisory cost. The first, which is the investment cost, commonly referred to as the expense ratio, is the actual cost that you pay to own the underlying investments themselves. And I'll start with active management. Active management is generally comprised of actively managed mutual funds, where you pay a manager or a team of managers to pick and choose the stocks, bonds, or other investment holdings that are underneath the hood in that particular mutual fund. Mutual funds, generally speaking, come with a much higher cost relative to their passive index peers, which is a great transition into what are called passive investments. Passive investments are exchange-traded funds, commonly referred to as ETFs, where the ETF itself is associated with an underlying index, such as the S&P 500. And because of the structure of ETFs, and because you're not paying a large team of analysts to pick and choose in an active fashion the holdings that are underneath the hood, generally speaking, exchange-traded funds come with a significantly lower expense ratio, which is great because it means that you're able to benefit by having a lower cost and allow time value of money and compound interest to work in your benefit over longer periods of time versus paying more for an actively managed mutual fund. It's really fascinating how many times I get asked, am I a fan of active management or passive management? And it's not a simple answer, not because it's a complex subject matter, but because my preference as a data-driven person is to look at each sector in a portfolio and determine historically, is there any benefit by satisfying that particular sector in the portfolio with a more expensive, actively managed mutual fund versus having a passive exchange-traded fund or ETF to satisfy that particular exposure. When we look at the historical data in terms of satisfying a particular allocation, let's pick on large cap growth, for example. If I look at an actively managed mutual fund that buys and sells large cap growth stocks, and I compare that actively managed mutual fund to a passive exchange traded fund or ETF, we want to determine whether or not the additional cost for that actively managed mutual fund is worth it. Because if the mutual fund has historically outperformed the passive ETF, then it might make sense. We also have to consider the tax implications, because one of the things that I used to see in my former career of consulting advisors was that there's a big gap between the tax world and the investment world. And it's very important that investors understand that their non-retirement money, their brokerage account, their taxable money, if you will, is invested and driven by the tax return, because there are tax implications not only to buying and selling in a taxable account, there are also capital gain and dividend considerations that have to be taken into account. Typically, when we look at actively managed mutual funds, they are what we call tax inefficient in taxable portfolios. And that's because many of the actively managed mutual funds, because of their inherent structure, force a capital gain onto the investor's Schedule D on their tax return. Many of the families that come to us outline the fact that one of their largest pain points and planning considerations is their annual tax drag on their Schedule D. And there's a way to modify the portfolio in a tax efficient manner to exit out of that actively managed tax inefficient portfolio into a much lower cost, more tax efficient exchange traded fund or ETF based portfolio, which allows the investor to keep more money in their estate and in the account so that time value of money and compound interest can work on the investor's behalf. One last point on active versus passive. When we satisfy a particular holding within a portfolio, we want to look at the historical benefit of using a more expensive active manager, meaning an actively managed mutual fund, versus a passive exchange traded fund. Because in some sectors, such as international markets, emerging markets, and so forth, historically, in some cases, it actually makes more sense to pay more for the actively managed mutual fund because of the historical outperformance of that mutual fund over its passive exchange traded fund equivalent or the index. So it's not a question of active versus passive, it's which type of holding makes the most sense in the context of the portfolio, and is it in the best interest of the client's tax return. The second level of cost are the administrative costs associated with having an investment account. And there are two types. The first are the trading costs, and that's where a lot of the self-directed discount platforms really make a big push to try and appeal to self-directed investors. The second are the annual administrative costs. We've all seen the commercials that free trades are good and paying any fees whatsoever for trades are bad. But it's not so simple, because many of the self-directed platforms, while they don't share this with you, they might keep more of the interest that you earn on the cash sitting in your account. The second annual administrative cost is the cost assessed by the custodian, and that's the cost to send you your statements and also your annual tax documents.